This is an Uncovered Japan Company research report on CTI Engineering, ticker 9621. CTI is Japan's largest listed general construction consultant. It surveys, plans, and designs public infrastructure, rather than building it. This video examines its government-funded moat, fortress balance sheet, overseas margin problem, resilience policy tailwind, and discounted valuation. At the report date, CTI traded on about 10.2 times forward earnings and 1.1 times book, with a 3% dividend yield. The equity ratio was 69.1%, and the balance sheet was effectively debt-free. The discount is not mysterious. Operating profit peaked in fiscal 2023, margins declined for 2 years, and fiscal 2025 brought the company's first guidance miss. A construction consultant is not a contractor. CTI's licensed engineers model flood risk, plan where a dam or bypass should go, design the structure, prepare procurement documents, manage construction, and plan maintenance. The concrete is poured later by someone else. Customers are mainly national and local governments, which buy technical credibility, relevant project history, and the qualifications of the assigned engineers. Revenue rose from 74.4 billion yen in fiscal 2021 to 101 billion in fiscal 2025, a 5-year compound rate near 7.9%. Operating profit, however, peaked at 10 billion yen in fiscal 2023 before slipping to 9.1 billion. The report attributes that pressure to a growing low-margin overseas mix and domestic costs running ahead. Domestic consulting produces about 69% of sales at a 12.4% operating margin. Overseas consulting supplies 31% of sales, but earns only a 1.7% margin. Overseas revenue has grown quickly through Southeast Asia and the United Kingdom, yet it contributes very little profit. Whether management can fix that economics is the single most important operational question in the thesis. CTI's moat is accumulated rather than patented. Difficult public tenders score the technical proposal, the firm's record on similar projects, and the credentials of named engineers. CTI has spent 6 decades compounding all three in rivers, dams, and disaster prevention. Winning the upstream planning assignment also positions the firm for downstream design, tender support, and project management, reinforcing repeat work. Roughly 84% of domestic orders come from national and local government. That concentration provides sticky, credit-worthy customers and demand supported by multi-year public budgets. It is also the central structural risk. A sustained reduction in public works spending would feed directly into orders. CTI's field and geographic diversity soften the exposure, but do not remove it. The equity ratio reached 69.1% in fiscal 2025, leaving CTI effectively net cash and financially resilient. Return on equity fell to 8.9% from 13.7% 2 years earlier. That decline reflects weaker profit as well as a larger equity base. The balance sheet protects the company, but management must deploy capital and restore margins if shareholders are to earn stronger returns. CTI's Sprong 2030 strategy aims to lift revenue from 101 billion yen toward 130 billion. Japan's national resilience spending, aging infrastructure, and disaster prevention provide a credible demand base. Growth is also expected from construction management, energy, information services, and overseas operations. The report is careful. Those newer fields and overseas margin recovery are not yet proven profit engines. The report compares CTI's roughly 10 times forward earnings with about 19 to 20 times for OYO and NJS. A low multiple alone does not prove mispricing. CTI's 2-year margin decline, overseas dilution, and broken guidance record deserve a discount. The valuation question is whether fiscal 2026 margin recovery and stronger capital returns can narrow it without assuming peer parity. The author's 3-year scenarios range from 2,430 yen in the bear case to 3,410 in the base case and 4,550 in the bull case, against 2,613 yen at the report date. These are not forecasts or targets. They show how revenue growth, margin recovery, and the applied earnings multiple drive the outcome. To conclude, CTI combines a defensible public infrastructure franchise, strong national resilience demand, and a fortress balance sheet, with a notably low valuation. The report is equally clear about what must improve: overseas profitability, domestic cost control, return on equity, and management's delivery against guidance. For the complete evidence, assumptions, primary sources, and risk discussion, continue with Uncovered Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.